Today, we're tackling a topic that's on everyone's minds: money. We all work hard for it, but what do we do with it once we've got it? Well, here's a hint for you: stuffing it in your mattress isn't a great idea. So let's break down what we're going to talk about today for you right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Joining me today for this discussion is Justin Waring from the Chief Investment Office. Justin, you put out a blog recently talking about top 10 reasons why we should all be putting cash to work. I know we don't have time for 10, and you've got the 5 that you love the most. So let's get right into it, Justin. What's the first thing on your list when you're talking about people about why they shouldn't hold cash?
Thanks for having me, Anthony. The first reason is because inflation destroys the value of cash. Since just 2007, cash sitting in your bank account has lost about 24% of its purchasing power in US dollar terms. And that means that your money just doesn't go as far as it used to.
Great. Yeah, I mean, look, if you look at that chart, it's clear that you can see the value of a dollar doesn't hold up thanks to inflation. So, okay, let's take it then. What's number 2?
Well, the second reason is that interest rates are going to fall. So cash yields look pretty attractive today, but that's not going to last. And as interest rates fall, bonds are going to gain in value versus where they're trading today, whereas cash is just going to get less yield. And that means that we're expecting a higher return from most portfolios than we are from cash, which is a stark contrast to 2022, when cash was really the only thing that added value other than commodities in many people's portfolios. So it's time to shift today from cash to bonds.
Okay, good. What about number 3? What's coming up for you next?
Well, obviously, cash is really important if you have spending needs tomorrow. But investing for the long term, it seems risky because we only live through short-term holding periods. So, for example, if you look at the S&P 500 every day, it's basically a coin flip. There's like a 54% chance of a gain and a 46% chance of a loss. But if you're able to extend your time horizon, for example, a 5-year period, the odds of a gain in the S&P 500 go up to about 88% for the S&P 500 and about 95% for a 60-40 portfolio. So cash is good if you need money tomorrow, but it's a really poor investment over the long run because you're missing out on what we call opportunity cost of investing in a better long-term portfolio.
Great. And what I love about that too, Justin, is the advice of it's never too late. So if you're not investing properly, start today. Even if it's 5 years, 10 years, if you got 20 years, even better. All right, so what's next on your list?
Well, speaking of which, market timing is really challenging. If you just miss the 1 day or 1 week best performance of the market, it can really chip into your return. So, for example, if you'd been invested since 1988 and you just missed the best day since then, your $100 investment would have missed $425 of growth just from that 1 day. And if you missed the worst month, you'd be $1,200 behind a buy and hold portfolio.
Right. You always say it's not timing the market, it's time in the market, right? So that's, I think, a really good lesson for everybody here. All right, so what's number 5, Justin?
Well, this is the most important one, is that really when we think about risk, the real risk is missing your goals. So failing to meet your goals. So cash plays an important role for money that you need to spend tomorrow. If you have a more than 5-year time horizon, though, cash really shouldn't be a major part of your portfolio because it just doesn't play the right role for preserving and growing your purchasing power. And so we think about money in what we call the liquidity, longevity, legacy sleeve. Long story short, what we're basically saying is if you have a time horizon of 3 to 5 years, you need to protect your portfolio from stock market drawdowns, bear markets, big market disruptions. But if you can outlast that type of short-term disruption and invest for more than 5 years, you should really be invested in a diversified portfolio that takes advantage of the long-term growth potential of a stock bond portfolio. Of course, maintain diversification, but cash rarely plays a big role in those longer-term portfolios.
Great, Justin, thank you. So I love about making sure you're setting your goals and meeting those goals, and obviously having a conversation with a financial advisor is key to that. But as we're wrapping it up, what should be on the top of mind for investors moving forward based on the top 5 of the 10 that you talked about today?
At the end of the day, there's no one size fits all portfolio for everyone. If you have cash in your portfolio today that you don't need for 3 to 5 years, you should definitely talk with your financial advisor about getting it to work so that you can protect your purchasing power and grow your wealth for spending needs that are in the long run.
Yeah, burying money in coffee cans in the backyard, not a great idea, Justin. Thanks for settling that old argument for us. We appreciate you coming by.
Thanks for having me.
Great. Thanks, Justin. And for more information, visit ubs.com/views. That's our Insights website. Plus, you can follow UBS on all the social media channels, including Instagram, where we have our @UBS Trending account. You'll find content there that you're not going to find anywhere else on the internet. And if you have questions, please contact your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.